Well, welcome to another Mortgage Minute. My name is Jeff Harrison, not Art Alvarez. As you see on the screen, he'll be with us in just a moment. You know, things are really heating up in a good direction here in the desert. Of course, we're having the hottest summer on record. We had like 118, 118, 116. I think it's going to be 121 tomorrow. But the good news is, finally, the mortgage rates seem to be going in the right direction. I think Art described that as a ride on or a ski run at Mammoth Mountain. So today there's going to be, I think it's a fun topic. It's a four-letter word. I won't get into it. I'll let Art talk about that. Let's bring him on now. Art, how are you today?
Doing okay, Jeff. I think according to my phone, it says we're at 115. So. Well, I don't know how much that's a record. I can recall, almost 20 years ago, going to a new home builder award event and getting out of the car at 5 o'clock in July, and it was 121. So,
oh, geez,
this is actually pretty typical. It's called summer in Palm Springs.
Yeah, I don't know about you, but I remember a day when there were only named storms and they were hurricanes, right?
Right.
And now it's like, even this heat dome has a name to it. Every time there's a sneeze and it's on the weather, it has a name to it. I don't know what that's all about, but we're under a heat dome right now, and it just seems like an extended period of time, right? I mean, these are some pretty hot temperatures, but as always, what are we going to do? We're going to get through it.
Oh yeah, we always do.
Well, we're excited about today's show because it seems like things are trending in the right direction, both for the economy and for home buyers when it comes to rates. And I know you want to get into that. So I'm going to let you know that if you're joining us live and you have a question, please put it in the comments. Art is here to answer your questions. He'll take them live and you'll come with questions, leave with answers. If you're joining us and it's a review or a repeat, just put your questions in the comments. And again, Art will get back to you on that. With that, Art, I'm going to turn it over to you and have a great show.
Okay, thanks, Jeff. Well, hello, everyone. Welcome to the show. Want to get right into it in terms of what's hot and what's not in the bond market and mortgage rates. So let's start with taking a look at the 10-year bond yield. Actually, our rate grid, which is right there. Actually, what's happening right now is rates, I think, are relatively stable. We've had a week or so ago, they had come down from some really high numbers that we saw right after the 4th of July holiday. And then during this week, we had some dip in the 10-year bond yield. And right now, it's kind of gone up a little bit. But you can see on the rate grid here that most everything is in the low to mid sixes. So I think the good news on that is we continue to see a relatively stable situation. Rates aren't climbing significantly higher. And just by the way, for anyone who may be new to the program, when you look at this rate grid, I encourage you to click on that tab at the bottom about mortgage rates, because in there I go into some discussion about really what's involved in determining where rates are at, from a day to day, week to week, month to month basis. So feel free to check that out so you can get a better idea how these rates are established. So why are we at where we're at? Why are we at where we are? And it's because of where the bond market is. I always say that that's the best benchmark. If you look at the 5-year chart, what's interesting about it is we're at 385. And actually, this chart's a 1-day chart. But if you look at a 5-day chart, we were at the same 385 yield last Friday, about almost a week ago. So in reality, we were this high a week ago. We actually dipped down to just under 375 midweek. Now we're back to 385. So in that regard, overall, the good news is it hasn't gotten worse since last week. There were periods during the week where rates were a little bit better. In fact, almost about 0.1% better. So what's causing the movement this week? Well, it's a few things. For one, retail sales came out. And in fact, when I give you these numbers, what you're going to see again is some mixed signals in terms of different economic data. Retail sales came out up 0.2. It was forecast to be up 0.5. So it was weaker than expected. The other economic data point that came out this week, which was yesterday, was this morning, is initial jobless claims. They were forecast at 240,000. Well, it turns out initial claims were lower at 228,000. So that's, of course, perceived to mean that the job market continues to be strong. Then the other data point that was released today is the Philly Philly Fed Manufacturing Index, and that was predicted to be down, minus 10. Well, it turns out it was the actual was minus 13.5, so weaker than expected. And what that tells us is there continues to be a decline in manufacturing activity, at least in regard to the Philly Federal Reserve area. And then the other data point that was released today is the leading economic indicators. That was forecast to be minus 0.6. Well, it came in weaker at minus 0.7. And in fact, this indicator has been dropping or declining for 15 months in a row. So what happens here? Well, the stock market made a move upward because the economy appears strong because of the jobless numbers. But at the same time, we've got these other data points that are showing weaker conditions. And of course, what did the bond market focus on? Bond yields actually got a little bit higher today, not terribly higher, but they went higher, mostly because of focus on the jobless claims. So I think job numbers in general tend to get more attention in the markets and are more associated with movements in bond yields than these other indicators. So that's where we're at right now. Again, I think modestly good news that rates are at least staying relatively stable and not climbing substantially like it looked like they were doing a couple of weeks ago. So with that, I want to get into what is probably one of the most important things that are involved in the mortgage industry and applying for a mortgage and frankly applying for other types of loans too. And that is credit scores. So I want to get into what I call all about credit scores. And this is kind of an interesting topic for me because I'm old enough and have been in the industry long enough. When I first got into the industry back in 1982, January, we didn't have credit scores. Credit scores were not used in terms of making loans to home loan applicants. So we got credit reports. They had different data on them, but all of that was evaluated essentially subjectively. There was no scores used, and so it was kind of a cumbersome process. If there were derogatory items, borrowers had to write letters and explain each one, and then they were kind of at the mercy of an underwriter who would, try to review that objectively. But let's face it, that process ultimately was more subjective, and it was a pretty inefficient process. So, where did credit scores come from? Well, the pioneer in this new analytic that was now used and is key to the mortgage industry in particular. Was a company called Fair Isaac and Company. They're a data analytic company that are really the leaders of developing credit scores that are widely used now in every type of lending. Now it's called FICO, Fair Isaac and Company. That's an acronym, FICO. So they're really the leader in terms of scores. So what's in your scores? The most common question I get is what makes up your credit score. And by the way, this information was actually part of a presentation that I saw just a couple of days ago, actually, from a gentleman who runs a company, a nonprofit company that helps people educate them about their credit scores and help them improve credit scores. So I'll give you his, get more specific about his information a little bit later. So again, what's in your credit scores? Well, let's start with the most important factor in your credit score. 35% of your score is about your payment history. Well, that obviously makes some sense, right? There's probably no better indicator of what kind of credit risk you are to a lender than your history in making payments, and in particular, making payments on time. So that's the biggest component that makes up your score. The second biggest is how much you owe. 30% of your score is based on how much you owe. And I would point out that is probably in particular the case when it comes to how much you owe on certain types of debt like credit cards. So how much you owe on overall, and in particular credit cards, can have a major impact on what your credit scores are. Now, the next factor that affects score, and it's 15% of your total score, is the length of credit history. Now, we see this quite a bit with younger borrowers who may have some credit history. They may have 2, 3, 4 accounts that they've opened, and they have a payment history, and it's all perfect, no lates. But maybe that payment history is only 6 months old or 12 months old, maybe even 18 months old. That actually is going to work against that person, at least in the short run, because the length of the credit history hasn't been long enough to establish a trend. And so I've seen cases where I'll encounter a borrower who's, in maybe early 20s, They've got 3 or 4 accounts. They're all perfect, no lates, no derogatory items at all. And yet their credit score is, 702 when they would expect it to be higher. And it's all about how long they've had a credit history in order to analyze a trend. Now, the next component of your credit score is new credit. So 10% of your score is going to be based on new credit. So if you have, say, several accounts that you've opened recently, well, that's going to affect your score. Not hugely, but it is going to be 10% of the total score, or 10% impact on the total score. So that's important to know. And then the last component is 10% of your score is made up on your credit mix. And this kind of goes back to what I said about credit history. On how much is owed. If you have a lot of credit card debt, maybe you have minimal installment debt, maybe you have just a mortgage obligation, but you've got 6 or 8 or 10 credit cards, maybe all with high balances, that is going to be a factor in terms of your scores. But again, credit mix is 10% of the total. So what's interesting about what I just went over is maybe some of you are wondering, what about inquiries? When it comes to inquiries, that is probably something I hear most often from prospective borrowers, is the fear of inquiries and comments that they make to me about, hey, before you pull my credit, I had a couple inquiries and it really reduced my score. Well, folks, I got to tell you, in most cases, what I see, even after I'm told that, is it's really not true. Inquiries do not have a major impact on your score. At least mortgage inquiries do not. And that's actually true with auto loans as well. So while they can be a factor, FICO actually says a typical mortgage inquiry is if it's going to have an impact on your score, it's probably limited to no more than 0 to 4 points. It's a very, very minimal impact. And you can have multiple reports pulled for certain types of loan shopping, like mortgages and cars, and they're all treated as one. So for all those reasons, inquiries are not a major factor in your score, and that's why you don't actually see that on this pie chart. So keep that in mind. They're not something you need to worry too much about, at least in most cases. So more about credit scores. One of the things I also point out to people is I'll often, as I encounter someone who's looking to apply for a mortgage, and I'll ask them about what they think their credit score is, and they'll usually reply with a reference to some source like Credit Karma, or maybe one of their credit cards, and they'll tell me what the score is. Now, usually what happens in that dialogue is when we get to the point of pulling the mortgage credit report, I would say in a majority of cases, that score on the report I pull is going to be different than the borrower told me that they saw on Credit Karma or from one of their credit cards. And the reason is, and this I don't think is well known, is that there are multiple FICO scores versions that different lenders use. Not all lenders use the same type of FICO score models. And that's true not only with lenders, but even the bureaus. And part of the reason for that is FICO score versions are continually updated to take into account changes in behavior of people as it relates to acquiring credit, because that can change over time. Now, with FICO scores, there's typically a base FICO score, and then some lenders, particularly like credit card companies, auto lenders, they may use some industry-specific FICO scoring models that kind of dials down even more, in detail about that particular borrower's behavioral approach to different kinds of credit, in particular auto loans, credit cards, et cetera. So, in fact, I would say that in regard to types of lenders, you can pretty much break them down into 4 different types: mortgage lenders, credit card companies, auto loans, and personal lenders or personal loans. So what is a little bit confusing is all these different borrowing types all can use, and many do use, different scoring models. And then to layer into that, the 3 bureaus, Equifax, Experian, TransUnion, they all use, to some degree, different scoring models. So that is going to create sometimes a little confusion with borrowers about what their score is and why, but just understand it depends on the type of loan you've applied for and what type of scoring model that lender used or that the bureau used in establishing your score. So there is going to be some variation. So just keep that in mind. One other thing, a couple other things I want to point out to you now as it relates to credit scores, and these are more recent developments, is paid third-party collection accounts really at this point no longer have an impact on your score. So that's important to note. And then the other thing, which I think is a little bit well known, is that medical collections have less impact on a FICO score 9. Now, I didn't get into all the different types of FICO score models and how they're identified, but just know that FICO score 9 is probably the most commonly used scoring model, what I would almost call the base FICO score model. And just have an understanding that when it comes to medical collections, they have much less impact when this particular scoring model is used. And we see that on the credit reports that we pull and the kind of credit score results that we get. So one other point I want to make about credit scores is you might be wondering what is not included in your credit score. And most of these on this list that's going to be pulled up, I think you're going to find it makes some sense. Of course, the most common or most obvious one is race, color, religion, national origin, sex, marital status. That has no bearing on your score, actually never has, and certainly never will be. The next factor that is not involved in determining your score is your age or where you live. So no concern there about your age or where you live. Of course, your age is a factor only as it relates to as to a mortgage loan, if you're old enough to be able to contractually be obligated on a mortgage loan. So just keep that in mind. Your salary and your employment info, not a factor at all, not considered. So it doesn't matter how much you make, doesn't matter what kind of job you have, that has no bearing on your credit score at all. If you have particular accounts, like in particular credit card accounts, maybe you're paying some very high interest rates. The fact that you're paying a certain interest rate charge on your account has, again, no bearing on your credit score at all. Another common thing that people are concerned about is if you have child support or spousal support obligations, that does not have an impact on your score either. And this is actually a change. I can remember years ago, this was a factor on some credit scoring models, is if you've involved in any credit counseling of any kind. We don't really see that on credit reports anymore, but some years back we would, and credit counseling would have some impact on scores, and in fact even on the underwriting process in terms of determining if you're qualified for the application you submitted. And the other thing I want to point out is, in addition to inquiries I commented on earlier, certain inquiries certainly have no bearing at all, and these include consumer-initiated credit scores. And what I mean by that is where you've gone into, say, the freecreditreport.com, where you can pull a free report once a year, or if you go to one of the credit bureaus, so you can pull a report from a particular bureau because you're curious, want to see your score. That's not going to affect your score. Promotional marketing pieces, you get that letter in the mail that says you're pre-approved for a credit card. That usually means that lender, that provider, has pulled your score, but those don't affect your score because those are typically done in a soft pull type of a situation. And then lastly, what they call admin. So if you contact your credit card company and maybe you're looking to get an increase in your credit limit, that inquiry, the credit card company is going to check your score, but again, a soft pull approach, it's not going to affect your score just because you made that inquiry in trying to get your credit limit increased or something like that. So just keep that in mind. Now, again, I got all this information from a presentation that was done a couple of days ago. And I think it's good information. Now, all this actually was presented, from FICO. So that's the ultimate source of this information I just went over with you. But the gentleman who presented it, his name's Aaron Hebner. He's with a company called the Ascent Network. It's a nonprofit company, and they help people help people both in educating them about credit scores, as well as helping you to improve the score. They've been in business, I think, for something approaching 25 years. And what's interesting is, in all my years of being in this business, I oftentimes get asked about, who I can refer someone to get help on improving their scores. And frankly, over the years, and from my practice has been, I generally stayed away from that only because I really could not find any credit score improvement, vendors or companies that I felt comfortable enough that they were legit enough to refer my clients or potential clients to. Well, when I met Aaron and got to know about the Ascent Network several years ago, what I learned is they were different. As a nonprofit, their focus really is on the consumer. I've referred people to them. They've successfully increased scores for people to the point where I was able to get them a mortgage loan when I couldn't initially. Their fees, on my understanding, are very reasonable. Again, they're a nonprofit. So if you need any help with credit scores, if you need more information about credit history, how to manage it, I would encourage you to look up his website, theascentnetwork.org, and he'd be happy to consult with you and give you some help in terms of getting your scores improved. So please take that advantage of that if you think you need any help with credit scores at all. Okay, so hopefully that's good information for you on credit scores. Now I want to move to kind of go back to a mortgage program spotlight, if you will. And I'm actually going to, revisit a program that I touched on. I think it's been a month or two ago on our program. And in fact, I'm calling this segment Community Mortgage Revisited. And the reason I'm doing this is I'm really, really excited about the program, in part because I'm about to, start a transaction where we're going to take advantage of this product. And I think it's really going to work out well for the particular situation that I'm involved in with the borrower. Now, what is this all about? Well, first of all, just so you know, this program is through a lender who is what's called a CDFI, a certified, now I've lost my train of thought, a certified development financial institution. And the idea is what this program provides is prime mortgages, but without having to document your income, employment, or your debt to income ratio. So again, you get a prime mortgage without income, employment, or DTI documentation. And by the way, that CDFI, it's coming back to me now, Community Development Financial Institution. They're certified by the U.S. Treasury Department. And so that's what's so unique about this program. This might sound crazy. You can get a loan without documenting your income or where you work and without a debt to income ratio being calculated. Yes, that's true. And part of the reason they can do that is because they are a community development financial institution certified by the U.S. Treasury. And the whole point of this product is really to address and to target an underserved market in the mortgage industry. And so I think this program does very well with that. And some kind of bullet points about what this program features. It's available on primary residence and second homes. And by the way, on the second home issue, the rate's the same. So there's no markup in the rate for a second home versus a primary, as is now the case with conforming lenders and conforming loans. Of course, that happened a year ago where the agencies, Fannie Mae and Freddie Mac, now price second home loans as if they're rental properties. In fact, the rate on a rental property, the rate on a second home is going to be the same as the rate. They're going to be the same rate. It used to be a second home rate would be the same as a primary residence. That's no longer the case, hasn't been for over a year. The other thing is on this program, your loan is underwritten and approved based on your loan to value, based on your credit score, your FICO, and your liquidity. You have to source, you have to verify the money you have for the down payment. So income is not documented. Employment is not documented. In fact, those are not even put on your application at all. Your debt to income ratio is not calculated. So this is also known as a no ratio loan because you don't document your job, you don't document your income, and we don't calculate your debt to income ratio. And the other nice thing about this product is in terms of verifying your liquid assets for the down payment and closing costs, we only have to verify those assets for a 30-day seasoning period. So no longer, at least with this product, do we have to get 2 months bank statements or the most recent quarterly statement. 30 days of the seasoning, meaning one monthly bank statement or account statement, is going to be sufficient in most cases. And in fact, with some accounts where maybe you have automatic deposit of your paycheck, with that kind of situation, we only need the first page of the bank statement to show the starting and ending balance. We don't need the rest of the pages. So the issue of where you work at and what your income is from your job doesn't even come up. So what kind of borrowers is this really good for, or who is really targeted with this kind of program? So let me give you a list, because chances are maybe you or someone you know might fall into one of these categories. The basic idea here is that this program is for borrowers who are the type of borrower who are unable to qualify based on debt to income underwriting. And you know what? There's a lot of borrowers out there who are good credit risks, but they're not able to meet this qualifying based on the debt ratio. So what kind of borrowers are we talking about? Well, the most common is self-employed small business owners. Another very common one is someone who has a job history that's volatile or irregular in terms of employment. And then another common one, particularly out here in the desert area, retired borrowers. They may have plenty of liquid assets. They may have very limited income, either from a job because they are retired, or maybe they have limited monthly income from retirement, whether it's Social Security or pensions, what have you. Maybe don't have a pension. So they may be asset rich, but monthly income poor. This is a great program for that type of borrower. Seasonal workers or gig workers. In fact, out here in the desert, we do have seasonal workers who work in hospitality during the summer. Some of the places that they work at, country clubs, et cetera, essentially closed down. We've got, people who are, farm labor who are seasonal. A lot of times they don't work during the summer months because that's not the growing season. It's too hot, et cetera. Of course, gig workers are very common. Another type of borrower that this program is good for and serves is owners of employees of cash businesses. There are a lot of cash businesses out there. So if you own one or you work for one and you're paid strictly on a cash basis, this is a great program to take advantage of. Of course, if you have the down payment money. If you're someone who changed your jobs, maybe entirely into a new industry, it's not related to your job history at the time of the change, you don't have any sort of education or training that you can document to support the new industry or job you're in, which can create problems in getting qualified for conforming loan. This is a great program for that kind of employment history challenge. You may have some transition from recent health, family, or other life events, which can, certainly be an issue in terms of interrupting employment, interrupting employment income. So again, this is a program that's really good at helping that kind of borrower. And lastly, this program is available on refis, both second homes as well as primary. And this can be a way to unlock trapped home equity in a situation where maybe you're one of these types of workers or borrowers that I just described, upper portion of this list, and you already own a home, you got a lot of equity. This is a good program that'll help you tap into that without going, again, through that debt to income underwriting. So I really think it's a great program. I really want everyone to know that it's available to you or someone you know who are facing these kind of challenges and have been frustrated by the inability to get mortgage financing, even when they have some down payment money. The reason I bring up the down payment money is this program does require a minimum of 20% down. But guess what? The loan amounts can go up to $3 million. And again, for both primary and second homes, of course, that's a big issue out here in my area where my office is, and other parts of California. So this is got a very good use for that kind of borrower and the type of property that they're purchasing. So keep that in mind. I'd love to talk to any of you or anyone you know who is in need of this kind of approach to get mortgage financing. Don't hesitate to get in touch with me, obviously. Okay, with that, I want to go ahead and get into our closing question from last week. And in that regard, Jeff's going to pull it up just as a reminder. I had asked, or pointed out, higher interest rates have created affordability issues for many prospective home buyers. This has triggered renewed focus on manufactured homes as an affordable option. Can a prospective home buyer finance a single-wide manufactured home built in '76 with a minimum down payment? And it's interesting, this question, because I was just at a realtor event yesterday, and guess what? I had a realtor talking to me about manufactured homes. So there is more focus on that type of property, in part because of the affordability challenges in the marketplace, both because of high rates and the price level of single family homes and condos, stick built property. So the answer to this question, believe it or not, is yes. It is possible to get minimal down payment financing for this type of property. Now, key issue is the property has to be built, yes, in '76, but in particular on or after June 15 of 1976. That's when new building criteria were issued, and so that type of or that date of build has to be the case. In other words, homes built prior to that date are going to be problematic for the type of loans that we're able to arrange. The other thing is the manufactured home does have to be fixed to the land with a document called a 433A recorded. That establishes that the property is fixed to the land. It's not still on its wheels. It's not sitting in a mobile home park where you're paying space rent. It is fixed to the land. The 433A is recorded. That's what establishes the property as real estate. And so with that in mind, what kind of loan options am I talking about with a minimal down payment? Well, the one there's actually a few. One is FHA. With FHA, you can get a loan with a 3.5% down payment, and your minimum credit score, believe it or not, only needs to be 580. That's terrific. Again, for someone who's a lower income borrower, maybe has some credit issues, but they'd like to get a home. They're looking at manufactured homes. This is a great option for them. Another option is VA loans for a veteran. Again, you can get a VA loan, 0 down payment for a single wide manufactured home built on or after June 15 of 76, even with a minimum credit score of 580. Again, terrific opportunity for someone who otherwise may feel like they've been shut out of the market to be able to buy a home at all. Well, guess what? There is a solution there. Now, with conventional, what we call the conforming loans, Fannie Mae and Freddie Mac, you can get a loan on a single wide manufactured home built by that June 15, 76 date with 5% down. Minimum score does have to be higher, but at 620. So just keep this in mind. This is a way to understand that if you want to get a home and maybe you're a first-time home buyer and you've got some issues in terms of income level, credit score level, there is options. I would say, of course, most manufactured homes that are purchased, I see more double wides purchased versus single wide. So a lot of lenders won't touch single wide. I can do both single and double wide. We do several every year. I love doing these kind of loans because I'm helping folks who maybe are really challenged with getting their first home, and it's pretty gratifying to be able to help them accomplish that. So with that, I'm going to go ahead and finish up with our closing question for next week. And this one's kind of an interesting one. Due to unfortunate circumstances, a prospective buyer had a previous foreclosure on an investment property only 15 months ago. The buyer is now looking to purchase a second home in the Palm Springs area, listed for $1.5 million with a 20% down payment. Now, the period since the previous foreclosure is too short to meet minimum adverse event wait periods for most loan programs. So, will this prospective buyer be able to obtain institutional financing for this desired purchase? Well, tune in next week, and I'll have the answer for you, and it will be on the house. Jeff, back to you.
Well, Art, that's some great information. I love the whole idea about manufactured houses or trailers that are fixed to the land. It seems to me like that's a great opportunity for those people who are saying, "Hey, young couples getting started, and maybe that a 3-bedroom, 2-bath, $500,000 home in the Coachella Valley or anywhere in Southern California really is out of reach, but a nice manufactured home that has that 433A program with it." Sounds like you can do that.
Well, yeah. And like I said, I do several every year. And of course, manufactured home price levels have gone up too, but still, relatively speaking, they're a much more affordable home option than this, traditional stick-built single-family residence or even a lot of condos, particularly out here in the Coachella Valley area. You look at places like, Palm Springs and Indian Wells and so forth. Some of these condos can be quite pricey. So, and the other thing about manufactured homes, particular newer ones, the quality of construction is actually very good. It's terrific. And I've made loans on some manufactured homes that, boy, at first glance, looking at the appraisal report or something, or the multiple listing, it's hard pressed to realize that that's a manufactured home. I mean, some of these are built very well, very high quality, and something that I think a lot of people would be proud to live in. So I just think it's a good option that should, serve a lot of folks. I've actually had other lenders refer people who were looking to, finance a manufactured home, in part just because that other lender didn't want to mess around with the loan amount because it was too small for them to deal with. We're not that way. I'm very happy to arrange smaller loan amounts for people. The type of work involved, whether it's a $100,000 loan or $1 million loan, it's pretty much the same. And I certainly don't want to turn anyone away who needs a modest loan amount, maybe to buy this kind of property type. So we do it all the time. We like to do it. So.
And your information, let's get your information on the screen so we can see where people can contact you. You can call Art at the office at 760-883-5700, or you can call him on his cell phone, 714-612-9035. Yes, comment and question in the comments. Will Art answer it if he's putting out for birdie on the 16th hole? The answer is yes. Art is on go. So he might tap that birdie in first, but he'll answer your phone.
I don't think I'll be tapping any birdies at 115 degrees. So.
Well, maybe you'll dart back over to Orange County and play a little golf over there. Who knows?
Yeah, right.
You can also check on, hey, what are the rates at mwloan.com? That's MortgageWorks website. You want to check that out. That's updated and information out there. As Art said, hey, check out that question about the loans to find out more information. I'm really liking the community program that you were discussing, and it seems like that opens up a lot of opportunities. And it makes me think of just yesterday, my wife was renewing her business license here in La Quinta, and she had to refile for her fictitious business license. And of course, when you do that, you have to put it in a public paper. And as you do that, I see that there are so many, it seems like, of those people who are small business owners that would need that kind of financing if they were going to go ahead and get a loan on a home. So I think that's a great idea. And you call that again, what is it called again?
Well, it's called a community mortgage. And as I was stumbling earlier in the presentation, it's funded by a lender who is a certified community development financial institution. They're certified by the U.S. Treasury Department. And what that allows them to do is bypass some of the conforming qualifying requirements that you see through, say, Fannie Mae, Freddie Mac. And a big focus, in fact, I would say the primary intent of the program is to be able to provide mortgage financing to an underserved segment of the market. So all of those folks that on that list we provided in terms of their situation, those are folks who, by and large, almost always run into problems getting qualified for a Fannie Mae, Freddie Mac loan, even an FHA, VA, et cetera. So this gives them an alternative. In fact, one of the subtle benefits of the program, too, is in a mortgage application, many folks, even watching the program, may be aware of this. On a mortgage application, we have to ask some questions about demographic information of the borrower. This gets reported to HUD as part of the Home Mortgage Disclosure Act. So that's important on these type of loans to fill out, to provide that information, because the borrower does have the option to not provide it. But in this program, it's beneficial to do so because depending on their demographic info that's provided, that may actually get them a little bit better pricing or a little bit better rate on the loan. Now, granted, these loans do have a higher rate than a conforming loan. But when you're considering your alternative is not to get a mortgage at all and keep renting, in a lot of cases, this program is going to serve a need. At least, and a lot of times these needs are relatively temporary or short term. This program has no prepayment penalty. So if you need this type of program because you can't qualify through the conforming terms, this is a way for you to achieve that home ownership. And maybe in a year or two, you can be in a better situation, get a conforming loan, refinance out of it, and you're on your way. So.
Fantastic. Well, if you have questions about these items or other items and you feel like your situation is unique, call Art at 760-883-5700 or again, 714-612-9035. That's his cell phone. And you can always visit him online or send him an email at art@mwloan.com. Hey, with that, Art, any last thoughts before we let you go for the weekend?
No, I don't think so. Just stay cool out there. I think for mortgage rates, the rest of the week, in fact, there's no economic data for tomorrow. So it looks to me like we shouldn't really see much in the way of any major movements in bond yields and therefore mortgage rates. Of course, as we go into next week, which we'll talk about, next week's the big week for the next Fed meeting and seeing what they're going to do in terms of, adjusting the Fed funds rate. The market's pretty much, I think, are about 90% convinced the Fed is going to raise the Fed funds rate another 0.25%. So we'll see if that actually plays out. If it does, as I pointed out before, I wouldn't be surprised if that announcement is made, which is what is expected, then that actually could help bond yields because they tend to run up right before Fed meetings. And then if the decision, the release of the information is as expected, that usually settles the markets down. So we'll see. Be interesting to wait for that and find out if it's going to happen. I think it will. So,
Art, you are a wealth of information, and anybody looking for information about loans, refinancings, HELOCs, that's home equity lines of credit. Even if you're thinking about, hey, I'm trying to figure out a way to put solar on my house, get a hold of Art. He'll show you how to do that, and it may be more beneficial than using a solar loan that is being offered, where maybe the whole system is set up a little bit difficult, where he'll show you how to use it in a much better way. Art, any other things before we let you go?
No, I think we're good, Jeff. Appreciate the time, and as I always say at the end of the show, thanks everybody for watching. And just remember, at MortgageWorks, we have the answers, and they're on the house.